Hello everyone, welcome back to the channel. Guys, in this video, I'm going to explain to all of you what I do myself before I press the trigger when it comes to trade the cash secured strangles, okay? Very simple strategy. For those of you that doesn't have a clue what I'm talking about, I'm going to explain to you guys what the strategy it is about. Very simple. So basically, okay, we have here the stock XYZ, whatever price might be. Let's call this thing here, let's say $100. Okay, what we're gonna do is we are gonna sell a short put above the current stock market, and we're gonna sell here a short put below the current stock market. So we have here a SC, stands for the short call, and we have here a SP, which stands for the short put. Okay, very simple. And of course, because we're going to sell, we're going to collect premium, because basically what we're doing is we are selling insurance. We are the house, we are the casino, we are the insurance company. Okay, because if the stock do trade below this short put, we are going to buy, and if it do trades above here, whatever price might be, we have to sell for this price. If our short call here, let's say, is 110, and the stock goes to 1,000, we have to sell it for the buyer for $110. So you're gonna lose the difference between 1,000 minus 110, which is $890. Okay, that's why when it comes to the way up, the Strangle, it is infinite loss. On the way down, only if the stock goes to zero. But of course, if we stick with ETFs, futures, index, guys, it can't go to zero. The ain't go to zero whatsoever. Okay, but very simple. So basically, it is a short call and it is a short put. Very simple strategy, but again, it's a used strategy amongst traders and investors when it comes to trading strangles. And what I do myself is I use the strangles, guys, to get into stocks at cheaper price. And of course, if I do have, let's say, 100 shares or whatever stock might be, I'm going to sell calls against it. But at the same time, if the stock do drop, I'm going to buy more, because if I do get a sign here on the short put side, I'm going to just add another 100 shares here to my portfolio, whatever product might be. Can be IWM, SPY, or even a stock like Google, Amazon, Nvidia, and so on. Okay, very simple. So basically, things that I do myself, the first thing that I do, it is to run, let's say, some kind of analysis to see if it do make sense to trade the strangles. Because what I want to get, guys, on let's say annualized rate of return, it is something like 30%. If I'm not getting 30%, whatever product might be, it can be ETF, stock or stock, I'm not going to open the trade, because I need to make at least 30% annualized rate of return. I'm not talking about here rate of return. And of course, there's two calculations here that you guys need to understand, okay? There is a return on the cost basis, which it is the amount you're going to have, okay, on your cash secure put side. All right, let's say the stock costs $180, multiplied by 100, you need to have $18,000. And of course, it is, okay, also calculate on your buying power, because although we need $1,800 to buy the 100 shares, when we open the trades, the cash secure strangle, we might only need to put up front 4.3 thousand, 1,600, 4.7, or maybe 6.1K or 1.9K, if you get what I mean. Okay, so there's two calculations we're going to do. One, it is on rate on risk, which it is to buy the shares, which is 100 shares of whatever stock might be, in this case here $1,800, and of course rate on BP, which it is the buying power, especially for those of you that do have portfolio margin. All right, so basically this is just a simple spreadsheet that I put together, and you guys want to get hold to this spreadsheet, of course, just click on the first link on the description below, be part of our community, and you can get the spreadsheet as well. Okay, so basically, very simple. Let's say, for example, we're gonna use here the IWM. So if you come all the way up here on the option chain, which it is 17 of of April, which it is our DT, which is roughly 32 days. We are going to sell here a short put, and we're going to sell a short call. Our short put here, it is $180. Let me go back here. And our short call, it is $222. Don't forget, IWM is trading now at $200. We're going to collect premium here twice, and we're going to sell here for a mid price of $2.78. We multiply this thing here by 100. Always, we're going to get $278. The infinite loss here, of course, it is on the call side, but on the put side, the maximum loss it is if IWM goes to 0, okay? So basically, let me see if I got this one here on the right date. So basically, we're going to sell here the $108 strike price. We're going to collect the mid price of the bid and the ask. And we're also going to sell here the 222 strike price. We're going to collect the mid price of the bid and the ask. And the mid price, it is $2.78. And as you guys can see, the buying power, it's only 1,935. That's why you guys need to have understand the two calculation. One it is when you open the trade in the buying power. Another one, if you do get assigned 100 shares on your cash secure put. Because although okay, that's $200 UI now, the IWM price, okay? Remember, we have here 222. This is our short call, and we have here our short put at $180. But the way I do is, this short put here, I treat that as a cash secure put strategy. Why? Because if IWM do trade below $180, I'm going to hold the IWM shares. Because once I get here for $180, if I do have IWM already with the base cost, let's say of 200, what I can do is I can also lower my base cost, and I'm gonna have here 200 shares of a roughly price of $190, which it is the mid price between 180 and 200. Just add those two and divide by 2, okay? And then what I'm gonna do is I'm gonna start to sell here short calls. So we're going from a cash secure strangle into a cash secure put into a the wheel strategy or covered call, whatever you want to call this thing here. But that's the way I do, because if I do get a sign, it doesn't stop here. Because for me to lose this trade, guys, the market has to drop a lot, and has to do a lot of things to take the money out of my pocket, because I got plenty of ammunition to deal with whatever stock market scenario might be. I'll give an example for you guys, okay? Let's say here, for example, this is IWM. Let's say that $180 here, this it is my short put, which is roughly here 2 standard deviation. If I do get a sign all the way down here, look at this, for example. I'm getting here a discount price from the current price. I'm getting about 10%, okay? But if I measure here from the very top, okay, from the very top, I'm getting here IWM with a pullback of roughly 26%. I want to buy IWM with a 26%. Who does want to buy the Russell 2000 with a 26%? But is this going to be the bottom 180 if I do get a sign? I don't know. I don't care. I don't predict anything. I don't guess anything. My goal is to make money when the stock goes up, when the stock trades sideways, and when the stock goes down. And if it goes down, guess what? That's fine. I know plenty of things I can do with this. I can manage this trade. I can turn it into a long-term investment, depending how much the yield I'm going to get on those shares. I can collect dividend. I can reinvest the dividend. And by the way, this is what I'm saying to you guys, okay? As you guys can see here, what we can do is, okay, we can do, like here, for example, we can collect dividend. Simple. Some of this thing here, it is cash secure put. There was a sign coming from a cash secure strangle. I could have done this thing here like a covered call, or I could have done this thing here just into, let's say, hold shares, which it is right now. And I'm collecting dividends here every single month and lower my base cost, okay? So this is very crucial that you understand. Open the trade, guys. Anyone can press the trigger. Any idiot in this world can press the trigger. But knowing what to do when you want to dance floor, underwater, when you get a sign, with your buying power going, let's say, getting very, very low, when the pullback, stock market having a bearish market, bearish trend, whatever it might be, it doesn't matter. Our goal is to make money on any price direction. And yes, that's right. It is possible, okay? In our community, we make money if the stock goes up, trade sideways, and go down. And if you do pass our strike price, guess what? We can manage that trade. But there's plenty of things we can do. So as you guys can see here, The first ticker symbol here, it is IWM. Second one, it is, of course, the SPY, the tracks the S&P 500, the triple Q, the Nasdaq, track the Nasdaqs. And of course, I got two stocks here. One is Google, which I love trade Google, by the way. And one, it is the darling of everyone online these days, which it is Tesla. Very, very obvious. As you guys can see, volatility here is very high. We're going to get the biggest return. And very, very obvious here, we're getting 57% here on rate on risk, which it is buying 100 shares of Tesla, and almost 200% if we're talking about here the buying power. For those of you that have, let's say, portfolio margin like myself, guys, you can make a lot of money on your buying power. But don't forget, margin or leverage, okay, you can use leverage, margin, whatever you want to call it, is used to take us out of trouble and not put ourselves into trouble, okay? We use margin for trade management and not to enter the trades. Although the calculation should I say, it is done on margin, buying power, and also on risk, you need to understand the two scenarios, okay? Because if we're getting here 57% on risk, which it is when we're going to be obligated to buy 100 shares of Tesla on strike price of what, 150, okay, which it is this cash secure put here, you need to understand that this, it's not too bad, not too shabby whatsoever. Where can you get 57% on the stock market? Guys, not many people can do it, okay? But of course, return, it is, guys, correlate to risk. The higher it is your return, the higher it is your risk. And that's why here Tesla is getting us the best of those five in terms of return, right? But of course, for those of you that are more conservative, what I suggest, guys, is stick with those ETFs. Okay, because the thing is, if the market do drops, guess what? The ETFs will follow the market when the market do recover. And sometimes some stocks might not. Google might drop 40%, Tesla might drop 60%. The stock market might go up to new all-time highs in 2 years by 2026, by December this year, and Tesla can still be down here. Okay, but when you trade the ETF that tracks the performance of an index, of course, if the index do recover, the ETF will also recover. Okay, so in my point of view, for those of you that knew when it comes to trade options, I stick something like the IWM, the SPY, or guys, the triple Q, okay? Very, very crucial. Although we're getting here 13.3, 9.8, that's not too shabby because the SPY here is giving us 9.85, which pretty much the return of the index. 15.3, way above the average return of the market on a yearly basis. So 13.3. And this on buying power, if you know how to manage your buying power, this can be amazing. Amazing, amazing, amazing. 14.4. 8.2, 12, that's not too bad whatsoever. And annualized, as you guys can see, we can pretty much double our account size with a proper risk and trade management. But these are the things that I do take in consideration when it comes to trading the cash secure Strangles, okay? Don't forget, guys, you can do open this thing here as a short call and a short put, just like a normal Strangles, but for you to have, let's say, secured, you must have here 100 shares, because if the stock goes to the moon, like Tesla, for example, from 222 all the way up to 1,000, you are covered here by 100 shares. But if you know how to manage your trades, you can start here with just the short put and a short call as a normal Strangle. And once you get a sign here, you can sell another put and the covered call, which become the cash secured Strangle. Okay, you can start however you like. Like here, for example, I'm starting here with just a normal Strangle with a short put and a short call. And if I do get a sign on this 180 call here, strike price, I'm gonna have 100 shares here. And then what I'm gonna do is I'm gonna sell another put and another call. And then if I do get a sign, I'm gonna have 200 shares, but my base cost is gonna be way lower than will be at $180. Why? Because if I do get a sign all the way down here, what I'm gonna do is I'm gonna sell all the way down here a short put at 130. So 130 plus 18, let's say 210, my base cost is gonna be roughly 165. So you guys get what I mean. So at the same time you're collecting premium, you're also lowering your basis cost. This is one of the best strategies for those of you that want to trade options. But buying power and position size, it is the main thing when it comes to trading Strangle. And be careful with the stock you might trade. Be careful with the growth stocks that pretty much can move anytime. I'm not talking about here GME, MC, none of that crap, okay? I'm talking about here good ETFs, okay, that trade pretty much sideways, like IWM, like EWZ, or even the SPY, but with the proper risk and trade management. And of course, with those 100 shares to make sure you are covered on the upside. Guys, thank you very much. Very, very cool. And I hope you guys do appreciate. But something like this, it is very important so you can have, let's say, an idea if it is worth to trade or not. Because in my point of view, to open the cash secure Strangle, I want to get at least annualized rate of return of 30%. Otherwise, I'll just buy the index and hold, or I just buy, let's say, the SCHD and just collect dividends and don't do nothing whatsoever. Because this strategy here, you do need to do some trade management. This is none of those nonsense laptop lifestyle, put the trade and go on holiday. It doesn't work like that. That ain't gonna happen. You must learn how to manage the trade. This one here is just the entry analysis, okay? Things that tell us if it's worth to enter the trade or not. From here, you can learn from, we can learn how to manage your trades, how to roll, how to convert into the wheel strategy, how to convert to cash secure put, how to hold the stocks for dividends, and how to do your base cost, to lower your base cost. There's plenty of things you can do, but this is just to analyze the trade to see if it's worth. In this case, as you guys can see on the buying power, all of them is giving a good return. When it comes to on risk, to buy those 100 shares on cash secure put, only Tesla will give us a return above 30%, okay? But 15.2, almost 10%, 13 and 18 is still a very good return compared to the market, which pretty much provide us 8% on a yearly base, not even annualized, on a yearly base. Guys, thank you very much. If you have any question, leave your question below and I'll get back to you as soon as possible. If you want to be part of our team, just don't forget the first link on the description below. All the best, stay safe and happy investing.